Let's start out with strategy number one, which is the most basic of all. And it's also the strategy that most people use in the options market, and that's simply to buy calls. So why would you buy a call? You'd buy a call if you think the market's going up, especially if you think it's going to make a big move in the near future. The risk is known, and that is the premium. So you can lose 100% of the premium, but like I said, at any time prior to expiration, you can always get back some of that premium by selling it in the market, even if you're ultimately a loser on that. Now, as a practical matter, when you buy calls, you do that in the expectation that the market will go higher and you'll be able to profit. But if it doesn't, there should be some point where rather than saying I'm going to lose 100% on this, you say I'm willing to lose 75% or 50%, but no more. So if you pay 2 for an option and it goes to 1, sell it at 1 and get back half of what you put in at least and move on to perhaps a better, more bullish stock. The break even in call buying is at the strike price plus the premium. And I mentioned this in the introduction. You're paying out a premium when you buy the call. To get that premium back, the market has to cooperate and go up. So if you buy a 25 strike call for $2, your cost is 2, you need to get the 2 back in the market. It's got to go to 27 by expiration at least for you to get that $2 back. At that point, you've only broken even. Above that, the option, you have to understand, when the option is in the money, will go dollar for dollar with the strike. And what that means in terms of the delta that we just mentioned is the delta will be 1. The delta is the rate at which the option goes up in value vis-a-vis the underlying. If the option is out of the money, the underlying goes up $5, it doesn't mean the option will go up $5 because it's not in the money yet. If it may have a delta of 0.50, if it has a delta of 0.50, it'll go up $2.50 for every 5 in the underlying. But once it gets above the strike, it'll go dollar for dollar with the stock. There's unlimited potential when you buy a call. I mentioned the Disney options I bought for 2 and were able to sell at 10. Well, that's because the market cooperated and it went up. If I'd held it longer, I could have gotten even more. Now, that's what happens when you catch a bull market with calls. You can make a lot of money. Some people have said the option buying is a little bit, and I'm over exaggerating here, it's a little bit like waiting for lightning to strike. Lightning doesn't strike that often, but when it does, it's a little bit like a bonanza. You may, to use a bad metaphor, consider it like buying a lottery ticket. You put in a little bit of money, and you can have a bonanza if you win. It doesn't happen often, but it does. And I'm not saying that buying calls has the low probabilities of winning the lottery. I'm simply saying that relative to what you put in, you can make a lot of money, and it's virtually unlimited. The downside of buying calls is that there is a high risk. The market must move higher or you will have 100% loss at expiration. This is what people mean when they say buying calls, puts in calls, is highly speculative, very risky, because it is. You could lose money if the market doesn't move higher. And in the section on strategies here, on strategy 1, I say on a move up, take profits to recoup your costs and reinvest profits by buying the next higher strike price. It's called rolling up. You can roll up, you can roll down, or you can roll out if you're rolling in terms of expiration months. Basically, what I'm saying is that call buying is not a one-shot deal. You don't just buy a call and forget about it. You undertake a call buying program. You buy calls, hopefully they go up in value, you sell them at a profit, and as the market goes up, you buy a higher strike, and then if the market goes still higher, you sell those, you at a profit, and so on as the stock ramps up in value. And you do this over and over and over again. Now, you do have to get stocks that cooperate to do this, of course. The equivalent to buying a call, of course, is to buy the underlying stock, but you know the downside of that, the stock costs a lot more. On the other hand, when you buy the put, it only has a limited amount of life, but it's much cheaper than buying the underlying stock. So that's the most basic of all. Now, in the book, what I've done is I've taken some recent examples that are real examples, real stock prices, real premium prices for the calls, just to give you an idea of what you can do. And on our strategy number 1, the call buying example, I picked out Cisco Systems. The symbol is CSCO, and it was trading at 1994, so it's virtually at 20. So I'm saying that you could buy a July 20 call for $1.25 now. This is early March, and July is 3 or 4 months away still. So you're paying $125 to control every 100 shares of Cisco with this option. Your cost, you know it, it's $125 a call. So your break even at expiration is the strike, 20, and what you paid, $1.25. So it's $21.25 is the break even. Anything above $21.25 in Cisco prior to expiration on the 3rd Friday in June will mean you have a profit on this strategy. And of course, the profit's unlimited because Cisco could go to infinity prior to expiration in July. So that's the most basic and the one that people are most familiar with.